Hey, good afternoon, everybody. Sorry, I had a little technical glitch there getting started, but appreciate your patience. I want to welcome you to this first educational event. We've got 4 of these coming up for the month of April, starting with Candlesticks this evening, and then we'll have 3 more events coming up later in April. April 8th, which is next Monday, we'll be talking about price volume. That will also start at 4:30 p.m. Eastern Standard Time. Then we'll get into divergences on April 15th at 4:30 p.m. That again is a Monday. And then finally, we'll wrap up with trading gaps, which will be on Monday, April 22nd at 4:30 p.m. Eastern. So those are the next 3 events. But tonight, what I want to concentrate is on candlesticks. This is, I would say, if there are 2 things that I absolutely have to have in my trading, one is clearly price volume. I need to be able to see the charts to see where price volume or where price support, price resistance exists. And then also I want to know the volume so that if we're going through one of these key levels, it's going to be even more meaningful if we see that volume picking up. So I really want to see both, but I at least need to see the visualization of what's taking place in the chart. I think it tells us a story. And so without candlesticks, I think the story is somewhat lost. There's still a lot of, secondary indicators that we can use to kind of evaluate the market. But for me, one of the most important is candlesticks. And so for that reason, we're going to be starting off with candlesticks tonight and then with price support and that whole price volume combination we'll talk about next week. So I'm going to go ahead and get started. Let's pull up the agenda for tonight. And so what we're going to do is we're going to talk about basic candlesticks. And I'll probably spend more time on that first chart, just giving you the basics, because it can be a little bit confusing, especially for somebody who's maybe using candlesticks for the first time. And just trust me, it'll get easier over time and you'll become a pro. If you keep working with candlestick charts, it will take no time and you'll begin to start visualizing a lot of things the way I see it. But that basic candlesticks is what we're going to start off with. And if you see that OHLC, basically what candlesticks do is they highlight the open, the high, the low, and the close. OHLC, open, high, low, close. And so those are the 4 things that we've got to get down and really understand in order to be able to use candlestick charts the best way that we possibly can, and to the most benefit for us as well. Anyway, then we'll move into reversing candlesticks, looking at bullish candlesticks that help us look for at least reversals off of a particular downtrend. And then we'll look at reversing candlesticks that are bearish. So these tend to follow uptrends. Well, they don't tend to, they do. They follow uptrends. And so you'll see these type of candles potentially signaling us to at least consider the possibility of a reversal after an uptrend. Then we're going to talk about how we scan for possible reversals at earnings beats. So you don't necessarily have to just be looking at the stocks you own or maybe a watch list, but you can actually run a scan against chart lists. And that's what we do at earnings beats. We put all of our research in chart lists, and then being able to run scans can quickly identify some potential trading candidates. So I'll talk a little bit about how we try to spot reversals using our scans. And then we'll do a quick little sneak preview of what you can expect from next week. So I'm going to go ahead and get started. We're going to take a look first at basic candlesticks. So the first chart I have up here is SMCI, and I picked SMCI Super Micro because it's been a very volatile stock. This goes back roughly about a month and a half, maybe a little less than a month and a half, but it has all kinds of different candlesticks on here. So I wanted to be able to point out and show you different candles and how I interpret them and what they mean and so forth. So I thought this would be a great chart to take a look at. All right. So first thing I want you to do is I've identified a couple of, well, 4 different chart or 4 different candlesticks that I think really represent everything that's out there. First, you'll see over here within this rectangle, I've got 2 candlesticks. Notice that they're both outlined in red, but one has it's all filled with red, and the other one's hollow. I'm going to talk about that in a minute. But those are 2, anytime you see that the outside is red or red bordered, that's telling you that you were down for the day prior versus the prior day's close. So anytime you see red, whether it's hollow red or if it's filled red, you have closed below the prior day's close. Okay. When you see black filled or black bordered candles, that means you have closed above the prior day's close. So generally speaking, black candles are going to be bullish in the sense that you're at least still going higher from the prior day. And when you see any red candles, you can rest assured that the move is still continuing to the downside. Now, I'll talk about the differences here in just a minute, but let's talk about the basics of a candlestick. So first, I'm going to start off over here with this hollow candlestick with the black border going around here. Now, what you will see on a candlestick is you'll see these little lines that come out of the top of the rectangle, and then at the bottom, there's generally going to be another line as well. The tops, or the top of the line and the bottom of the line, represent the high and the low of the day. That should be maybe something you can pick up pretty quickly. So if you're looking at this candle back from February 22nd on Super Micro, without even batting an eye, I can look and say, okay, the high, that tail or wick or shadow, lots of folks call them different names, but that little line that you see pointing out of this rectangle, this is just coming up to mark the high of the day. And this, what I call tail, is also referred to by some as a wick or a shadow. All right, but if we just take a look at the top and we were to come all the way across the chart, you would see basically that that day had a high somewhere around 1,000 for SMCI. And if you go down to the bottom tail, at the very bottom, and come across, we were probably somewhere around 830 or 835 is the low. 1,000 the high, 830, 835, whatever was the low. So that was where all the trading that day spanned. Now, if you look inside, you'll see a rectangle from the top to the bottom. You'll see a rectangle. It's either going to be a black outlined hollow candle, a black outlined filled candle, a red outlined filled candle, or a red outlined hollow candle. Those are essentially the only 4 candles you're going to see. One exception being, if you look at this candle over here on March 28th, you basically don't even see a rectangle. And what that's telling you is that the open and the close were almost identical. If that line is exactly flat, that means they're identical. If it's almost flat, it just has a little bit of color to it, then it means your open and your close were just slightly different. And it'll be outlined in black if you were up from the prior day, and it'll be outlined in red if you were down from the prior day. And so that's why we're seeing it red, because in this case, we were down from the prior day's close. Okay, so as you look at these rectangles, anytime you have a hollow candle, any hollow candle, you close above the open. So here's the close, hollow candle, that's the close. In a hollow candle, hollow rectangle, the open is at the bottom. So it doesn't matter if it's black outlined or if it's red outlined. You are still closing above the open for that day. The reason that they're different colors is because the close this day was higher than the prior day's close. The close this day was lower than the prior day's close. So outlined in red, it's still somewhat bullish because you closed above the open, but it's outlined in red because you actually if you were looking at your portfolio and this was the only stock you owned, you would look at it and you'd say it was a down day because I lost money. But the candlestick is saying, yeah, but you opened even lower. There was actually buying throughout the day. So it's much better to see a red hollow candle than it is to see a red filled candle. A red filled candle just kind of gives you that sense that there was a lot of selling throughout the day. The red hollow tells you that you actually finished above the open. Now, if you're looking at the black candles, again, you've got a black filled candle and a red filled candle. The black filled candle is filled in black because you closed above the prior day's close. It was an up day. You closed beneath the open, but it was still an up day. The red filled candle means you sold off from the open to the close and you finished down for the day from the prior day. So hopefully all of that makes sense. So the top of the tail is your high of the day. The bottom of the tail is your low of the day. Hollow candle, you open at the bottom of the rectangle and close at the top. Filled candle, or this filled candle, you open at the top and you close at the bottom. Filled, think about it as being bearish. You're closing below the open. Hollow, you're closing above the open. So the most bearish candles, in my opinion, are the ones, the red filled. The most bullish are the black hollow. And the black filled and the red hollow, they've got maybe characteristics of both. They're higher for the day, which is bullish, but they closed below the open. So they were selling intraday. That could be bearish. So these are just more uncertain type candles. You really have to take it in context with what's going on the chart. But any other time, solid hollow candle like this tends to be bullish. Filled, big red filled candle like that tends to be bearish. Hopefully everybody gets that. I know, listen, if it's confusing, I know maybe at the very beginning it'll be confusing, but as you use candlesticks more and more, you'll start to understand. I mean, just look at candlesticks every day and how they finish. So like today, SMCI, I mean, we kind of went up, we went back down, we're in a sideways, but we finished above the open today. We did have a long tail intraday. We got as high as 1,069, but we closed at 1,037, which is right here. We opened down here at 1,010. So you see how that open versus the close, we finished up $27 above the open. That's going to be one that you're going to see a black hollow candle for that because you finished up for the day and you finished above the open. So that's how we would interpret that particular candle. So again, if you don't quite get it, don't worry about it. Don't get too upset. Come back, review the recording. We'll send that out later tonight or tomorrow morning. So you'll have that to be able to look at again. And I started writing a lot of stuff on the charts. And then as we go through, you'll see I stopped writing because I'm thinking, well, you can come back and look at the recording. So I'm just spending a lot of time annotating and writing that I didn't need to really do. So anyhow, this is like Candlestick 101. This is the basic open, high, low, close, OHLC on candlesticks. And once you start to get this down, and so, I mean, I can look at a candle now. I know exactly what happened. As soon as I look at a candle, I can say, oh, that's a little bullish or that's a little bearish. And if it happens to be occurring at a major support or resistance or trend line, or maybe there's a divergence in play, these candlesticks, when you start putting them together with other indicators, can be really powerful. And so I'll show you a little bit of that in this presentation. So let's move on to the first bullish reversing candlestick, and that's the hammer. It's probably my favorite. And the reason it's my favorite is a lot of times the hammer, you'll see the tail, which is the low down here, go down below prior lows. I mean, if it's happening, if you're getting a hammer at support, a lot of times what happens is you get an intraday breakdown. Imagine what this candle looked like intraday when it was trading down at $68 here. It would have been a big red-filled candle. It would have looked so bearish, like you're breaking down below all these prior lows. This would not have been good at all. And then by the end of the day, it actually reversed. And the significance, the story that this tells, is that if you understand the way market makers operate, number one, their allegiance is to their institutional clients. Institutional clients will need to either buy or sell a large number of shares. And they go to their market maker and they say, okay, I want to sell this many shares, or I want to buy this many shares. It's up to market makers to obtain the number of shares that their clients want, their institutional clients. They've got to get those number of shares, but they have to do it at the best price possible. Well, one way to do it at the best price possible is to trigger a potential breakdown intraday. Because usually what will happen is the volume will escalate and technical sellers will come in, short sellers, or those that hold the stock on the long side. When they see that breakdown, they don't want to take any chances. At least the smart ones, that's what they should be doing. And so intraday, you're getting this breakdown. But what if market makers are looking to accumulate? That's where a reversing candle would come in. And so now all of a sudden, I'm seeing a breakdown that morphed into a major reversal at the close because, again, intraday, it was breaking down. It hit lows that it had not seen on this chart before, creating more and more sellers. Market makers were just sitting back, kind of saying, hey, keep coming. I want to buy all you got. And the only way you know whether or not market makers are going to buy on that breakdown, you don't know if that's a breakdown or if it's a reversal and a false breakdown until the close, until the end of the day. Because again, most breakdowns are not going, you're not going to see market makers buying shares of a stock that's breaking down unless they need to build inventory for one of its institutional clients. That's the reason why I want to know if I see a hammer at a major support level. Look at what happened here. Got the hammer, couple days up. Now, we ended up going up a lot, but when you're looking at these reversing candles, in the back of your mind, you should be thinking, I'm going to get a higher high tomorrow. That's what I'm thinking. When I see a reversing candle, first of all, nothing is guaranteed. We could see a breakdown at the open the next day. It's possible. But when I see a reversal, I'm evaluating the risks. Do I think after this reversal, we're going lower or higher? I can tell you in my head, I'm going to be thinking higher every time. So if I happen to see this reversal and it's at a major support level, then the chances are I would buy rather than sell. And I'd be looking for short-term gains, which over the next couple of days, this stock provided. I don't know where I would look. I mean, I'd be looking at the chart, maybe the 20-day, maybe the 50-day. I mean, if I came down here and I had a positive divergence, I'd probably look for the 50-day. If I came down here and didn't have a positive divergence, maybe the 20-day, or maybe it's a stock that I really like. This is in the semiconductor area. Maybe the fact that it's reversing on a major support level, maybe the stock I just want to buy and hold for a while. You come up with all those decisions after you see the signal. The signal is the hammer itself. So what you're looking for with a hammer is, first of all, it needs to have an open and a close in the upper 1/3 of the entire candlestick. So, an upside down hammer where you have a hammer at the bottom at market tops or at charts where you see a top, sometimes that's a shooting star. I'll talk about that in a little bit. But what you want to see is a long tail to the bottom showing potentially a lot of folks selling and then a big reversal into the close, which tells us market makers likely are on this stock on the long side. And when market makers are long, I want to be long. If I feel like market makers are short, I don't necessarily want to be short, because if I'm in a bull market, I'm not shorting. That's just my own personal strategy. But if I see a reversal at a top, I'm, even if I don't want to sell short, I might just want to exit. So anytime you get a reversal on the bottom, you're buying or thinking about buying. And if you get a reversal at the top, which we'll talk about a little bit later, then you would be selling. And some of these other things I'm looking at down here, like heavy volume adds to bullishness of reversal. That applies to any reversing candle, not just hammer. Corroborating signs of a bottom also add to the strength of the signal. So a hammer off of a downtrend is one thing. A hammer off of a downtrend at major support with an intraday breakdown adds a little bit more bullishness to the picture. So you're looking at, and then you can see down here, volume was picking up as well. So you average volume on MCHP, or MCHP, I should say, microchip. Normal volume, you can see, is probably down around 3 to 5 million shares. And on this particular day, it traded about 8 million shares. So you can see that volume was much heavier, which makes sense because you're probably going to see a lot of intraday stops being triggered and market makers gathering shares. And then right back all the way, in this case, went all the way back up to the prior high. Then pulled back to the 50, back to the prior high, a little bit of a breakdown here, and then a reversal back to the prior high. I mean, clearly we get through 92 to 94. That would be a really good sign for microchip. But anyway, I'm kind of getting off subject here. That hammer right there is something you want to be aware of. Next up, how about a piercing candle? So once again, you're in a downtrend. In order to reverse a trend, you have to have a trend. So if you're going sideways and you see a hammer print, that means nothing. It needs to be coming off of a downtrend. Same goes with a piercing candle. You're going down and then you're reversing with a piercing candle. So a piercing candle opens below the prior day's candle body. That red filled candle, you can see we actually opened just below it. And then you want to close in the upper half of the prior day's candle. So if you get up here and you close just a little bit above yesterday's close, that's not good enough. You want to be working your way back at least into the upper half of the prior day's candle. And then you get confirmation when the next day you see a higher price. Again, all of this occurs off of a downtrend. Heavy volume adds to the bullishness if you get that on a reversal. And if you happen to reverse at a key support area, in this case, this was the prior high right here. We went through it. So that left support at about 78. Notice we pulled back to 78 and then gapped up to 85. So now we have price and gap support at about $78. This reversal took place just above that 78 support level. And the key there is that anytime you're entering any stock, the closer you are to a support area, the better you're able to manage your risk to the downside. So the problem is if I buy this stock on a breakout up here above this prior top, and I'm looking at this chart and I'm like, well, here's gap support. I'll give it all the way down there. Well, if you're at 90 and you're willing to give it down to 78, you're giving up $12 or 13%. But if you get in at the end of this day where you see the piercing candle print, and maybe we're at 80 and a half, you only have maybe $2.50 down to the bottom of the, to the key support level that you're watching. So if this piercing candle doesn't work, you might lose 3% instead of 13%. And if you're right, if you were right here and you're still holding, well, from 90 to 125, you're up close to 40%. But from 80 to 125, you're up more than 50%. So your reward to risk is much, much better set up when you buy closer to support. That's one of the reasons why I like to buy on pullbacks. Everyone's different. A lot of folks like that momentum. They like to get the breakout, and as prices keep going up, they keep adding. The problem is for me that I got too much risk if I do that. Unless I'm going to keep a tight stop. I mean, I got to at least give it to the 20-day moving average when it's breaking out. I mean, here you can see we actually came down, tested it pretty nicely, and then jumped right back up again. But here, we actually closed just a tad below the 20-day. That might have triggered a stop. I mean, I might have gotten out on that right before it did this. But again, the higher you buy, the more money you're losing when it pulls back. The lower you buy, you're in much better position and maybe don't make those same emotional trades that you might make if you were buying high. So anyhow, that's the piercing candle. Next up, this is PayPal. I'm going to show you an engulfing, bullish engulfing candle. So here we had price support coming in roughly at about 59 or just above 59. And notice this red candle here that went just below the support area. This would have been back on August 18th. Then the 19th, we gap down. I mean, things are not looking pretty. Who's going to buy on this gap down? I mean, I'm not going to look at that at 10 o'clock in the morning or 9:30 and buy this stock on a gap down. I mean, for all I know, this thing could be absolutely falling apart. The only reason that I can see a big reversal occurring like that is market makers. Again, building up inventory, potentially, or maybe just trading on their own behalf. They trade on their own behalf. They don't always trade for institutional clients. They trade for themselves. They make money. But I would be thinking that market makers are in on this because I got a downtrend. I had an open that looked like it was just going to accelerate, and then I got a reversal. Now, in this case, again, if you don't like the chart, probably the 20-day moving average would be a great area to get out. If there was a positive divergence on this move in some form or fashion, maybe we get that 50-day test. Now, I don't look at this as a positive divergence, even though technically, I guess we are a little higher because we already went back up and reset the PPO above zero. So I don't go back that far anymore. That's a story for another day. That's going to be on the 15th when we talk about divergences. But here, I'm just looking for a possible trade, and that is a bullish engulfing candle. The difference between bullish engulfing and a piercing is just a bullish engulfing completely closes above the prior day's candle, not just in the top half. You completely engulf the prior day's candle off of a downtrend and then back up to the upside. These candles, I can't stress this enough, they are not long-term signals. Do not look at a hammer and say, oh, the bottom's in, I'm holding the stock for a year. Now, maybe based on other signals you're seeing, maybe you can come to that conclusion. But the candle itself is a short-term signal. And you might look at me and say, well, Tom, you said this was a bullish candle and I held it for 2 days. You know, I was in it for 2 days. It was going up and then it fell apart and I ended up losing money. And I would look at that and I would say, well, the reversing candle worked. We went up for a day or two. This doesn't tell us we're going up for 10 days or a month or, 5 years. It's a short-term reversing candle. That's it. All it is. It's the other signals that corroborate that short-term signal that potentially might make you think it's going to last longer. It's not the reversing candle itself. Make sure you understand that. Because you could look at this and say, well, look, a month later, it went lower. And I would be like, okay, I don't know what point you're making because we already had the reversal off of that reversing candle. It's not a long-term signal. So just went back down again. So it's more important to put all these signals together. But this is one of the first signals. As a short-term trader, I love candlesticks. Let's move on. Red hollow candle. So if we go all the way back to the beginning, remember, here was the red hollow candle, right? This was off of a downtrend, red hollow candle, ended up going higher. Served as a nice reversal. But here's a red hollow candle on analog devices. Look at this big move lower from 200 all the way down to 187.50. And then we gap down to 181. So we were down close to 10% in 4 trading days. And then we printed this red hollow candle. And we opened in the middle of this kind of support area and we closed above it. So I would have definitely been looking for short-term move back to the upside. And in this case, we had a short-term, went back to the 20-day before starting to roll back over. We held that low and then gapped up, went back up, and you can kind of see that, if we were in a bear market, cyclical or secular, and we had this kind of move and we went up to the 20-day, I would absolutely expect it to roll over and go down and set new lows. That's in a bear market. We're in a bull market. So just because short term it starts to look a little bearish, I personally don't consider shorting. I don't want to wait for a bounce to short. I don't want a short, period. I'm only looking at longs. So either I like it as a long off of this hollow candle or I don't. I either buy it or I move on to something else. I don't short. I like my trading to go with the trend. So if I believe the stock market is trending higher in secular bull market fashion, and I believe we're going higher, and I do believe all those things, I want to be in on longs. I do not want to be in on shorts. Worst thing in the world for me is shorting a stock and watching the market go up. Now, if that particular stock goes down, great, you can make some more money. But that's money that I could be putting into stocks that are benefiting from an uptrend. Not going to try to short. But anyway, that's the red hollow candle. So you have the gap down, and then you come back up, you finish above the open. That's why it's hollow. And it's red because we still finished below the prior day's close. It was a down day. We lost money. If we were in the prior day and we hold through a red hollow candle, we are losing money. Just that we're not losing as much as we were at the opening bell. All right, next up, Texas Instruments, Doji. So a doji, if we go back, this is what I was trying to point out over here. A doji is when your open and close are essentially the same or very close to the same. Sometimes there's just a little bit of movement. You see a little bit of the candle body. And when that happens, it kind of looks like sometimes you might look at it and say it's a doji. Some others might look at it and say it's a hammer. But they're similar. A doji, because your open and close are essentially the same, it's kind of given us a signal of indecision in the market. We're in a downtrend. 4 days in a row, red filled candles. And then all of a sudden we gap down, we trade below gap support. And then we come back up and close where we opened above gap support, leaving this tail down beneath it. And then next 3 days we're higher. But the beauty of these candlesticks as a short-term trader is if I get in and I'm using this as a key low, if the next day it goes down below that low, I can exit. Just take a small loss. And if I get all the way back, again, maybe I'm looking for a 20-day test. Maybe I'm looking for a recent high, which probably is what I would have looked for. Whatever it is, I can keep a fairly tight stop while I try to see if I can move up and hit my target. But a doji is, first of all, it comes after a downtrend. It has opens and closes that are identical or nearly identical. And you see a very, very tiny candle body. Sometimes no candle body. If they open exactly, I'm kind of just looking back to see if I can find any on this particular chart. This one all the way back here, maybe on May 23rd. Looks like that could be a doji. Maybe even recently, March 25th. Looks like a doji. But it's essentially where they are identical. Dojis can be bullish or bearish. Depends on what they follow. If they're following a downtrend, then you're looking for a reversal back to the upside. If they follow an uptrend, then you're looking for a reversal back to the downside. And just like all the others, you take other technical indicators into account. You're looking for corroborating evidence of that particular reversal. So in this case, gap support. A lot of times stocks will go back and fill gaps, and when they fill gaps, they turn back up to the upside, and that's what this one did. So that was a little bit of corroborating evidence. Had it been a little bit lower and we went down, we could have been testing gap support and the 50-day moving average at the same time. Both of those are bullish signals. So that adds to the doji. Those are the types of things that I would be looking for. All right, how about an island reversal? These are the last ones I was looking for. I really never did find great island reversal and island cluster reversals to show you. But essentially what it is, it's a one candle on an island. So you got a downtrend, you gap down, it's on an island. The next day you gap up. And essentially you leave that one candlestick all by itself on an island. That is what's called an island reversal. So we're in this downtrend, we gap down. Now it also was a red hollow candles off a downtrend are reversals, right? Gap support we were testing at the 50-day moving average. A lot of different signals. We're in an uptrend. And so we had a chance down at the 50-day moving average, down to gap support. It's one of those where we actually opened beneath both the 50-day and gap support. So I probably would have waited to see maybe if it started to show some strength later in the day, and then use the intraday low as maybe my stop. And trust me, trading is a lot easier hindsight. I can tell you all the perfect trades in hindsight. But I do think going back and studying history is really important in trying to spot things in the future as they occur. I mean, yeah, we'll always be able to trade better with hindsight. It's a lot easier. You don't have any anxious moments. You know exactly what happened after. You do it in real time, and then the market doesn't do exactly what you're expecting, and you're like, oh, wait a minute. Should I be out of this? Should I be doubling down? Should I, you start testing yourself psychologically and emotionally. So it's always easy to look back and say, yep, that was a perfect reversing candle. Sometimes they don't work. And that's why when I do get in, I want to try to manage my risk as much as possible. I want to try to find those other corroborating signals where I can say, hey, if this stock goes back down below this low, not only is it reversing, or failing on this candle, but it's also failing to hold gap support, and it's failing to hold the 50-day. And maybe there's a trend line. Maybe it's failing to hold a trend line. All of those other corroborating signals you need to consider as well. So candlesticks by themselves are great, but they're not the whole story. Now here is an island cluster reversal. Now this one's kind of interesting because we're downtrending. We gap down below support for all three of these candles, and then we gapped back up. And this time, instead of leaving one candle on an island, we're leaving three. Anything more than one is an island cluster. Island reversal is reversing and leaving one candle on an island. Island cluster reversal is gapping down, going sideways for a period of time. It could be 2-3 days. It could be a week. Sometimes I've seen it a month or more. But you gap down, you kind of trade sideways for a while, and then you gap back up. And you leave all of that cluster on an island by itself. And then reverse back up. And again, where you think it might go depends on a lot of things you're looking at. In this case, lower low, higher PPO. Positive divergence. When we gapped up, that left these on an island, which is the signal that this is a reversal. And from there, I would have been looking for a 50-day test. I look for 50-day when I get a positive divergence. I look for 20-day when I'm just going straight down. Like here, I'm going down, got a little bit of a bounce, never got through the 20. Here, I don't know, maybe we had one little bit slightly lower low, went to the 20. And then on this one, I mean, I think it's really clear that we were much, much higher on the PPO. So again, this is how we could use corroborating evidence to get into a trade and feel pretty good about it. All right, those are the bullish reversing candles. Now, the bearish are very similar to the bullish. In many cases, it's just the opposite. You're just looking at exactly the opposite conditions that are present. So first, let's start with a shooting star. Here's a shooting star. It looks like an upside down hammer, doesn't it? So hammers mark bottoms. Shooting stars mark tops. It's like we broke out intraday. I mean, we were trading on sleep number intraday right here with a breakout. We were at the highest level we had been since the end of October. And it looked like we were making a breakout. But we made that false breakout and failed to hold it. Volume was kind of light. So the actual breakout intraday probably would have been a little suspicious for me. I still think this is a stock that could do very well going forward, but I need to see this breakout. I'm waiting. This is on one of my watch lists. I'm just waiting because this is a stock I think that was like a $45, $50 stock. And, you know, if small caps start to perform well, this is a small cap, very small cap. And if you get a breakout and small caps start to lead, these are the types of stocks that can move up 100, 150% in maybe a few months. So anytime small caps get going, I get excited because individual stocks at the small cap level, they're risky, but they can produce some tremendous returns. So watch SNBR trying to get through this level. After it failed, it went back down, and you can see just barely going below the low after the earnings related gap higher. And now we're turning up. Today was a not so great day. We'll see maybe if the 20-day holds. But really the key on this chart will be getting through about $17.50, maybe even $18 and closing there. But again, this is an upside down hammer. So what you're looking for is an uptrend. Anytime you get a false breakout or a long tail above resistance and fail, come back down, and then have that shooting star to boot. Shooting star is reversing. And then anytime, any candle where I see a false breakout, I'm thinking short term, we're going to go lower. So a lot of folks say, well, you know, I don't know when to sell. Well, if you're a trader and you see that, that is like beating you over the head to sell short term. Now, again, you might be holding Sleep Number because you think it's a great stock, and you might want to hold it for years and years. And if that's the case, then maybe you don't care about what just happened at resistance. But if you're a short-term trader, I mean, that is the difference between pocketing a profit and having cash available to move into another trade, or holding on to it and losing any profit that you had, and meanwhile foregoing the chance to buy another stock. So candlesticks, when someone asks me, how do you know when to sell? One of my first answers is going to be candlesticks, reversing candlesticks. If you see one as a short-term trader, especially if it's occurring at a major resistance level, take the money. That would be my suggestion. Of course, you have to do what you feel comfortable with. But if I see that, I'm out. I don't care if it gaps up the next day. That candle tells me that my risk is exceedingly high holding on to this stock. You'll never have a guarantee in the market. So all you can do is evaluate risk. If I see that, I think the risk is to the downside. If I'm in a long, I want out. Autodesk, this is the dark cloud cover. So I showed you piercing. Remember where the piercing candle comes up and closes in the top half of a candle body? Here we have an uptrend and the opposite occurs. We gap up and we close in the bottom half of that prior candle body. And down we go before we end up going sideways and breaking out. This candle doesn't tell us any of this, though. What it tells me is that the next day, at a minimum, I'm going to be looking for a pullback. So again, let's say I was trading the stock. You know, some might look at this and say, well, yeah, but it was at $220 early in the day. And at the end of the day, it's $214. I want to wait until it gets back up to 222 and then I'll sell. Well, that's great, except reversing candles a lot of times don't work that way. So you get the reversing candle, the odds of going lower are greater. So if I had gotten in maybe on a 20-day test, yeah, I'm giving up some of my profit, but this candle is telling me that my odds are I'm going to keep going lower. So taking a smaller profit is better than watching it all disappear. So the dark cloud cover essentially is the opposite of a piercing candle. Piercing is bullish at the bottom. Dark cloud cover is bearish at the top. NVIDIA. So I showed you bullish engulfing candle. Look at NVIDIA going up, 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 up. Look at that reversing candle engulfing where it opens, gaps up, completely engulfs the prior day's candle. And look at the volume. Now, the only real down day or only chance that you had of this pulling back was the very next day. But we're still trying to get through these tops on NVIDIA. I think it's going to happen probably sooner than later, would be my guess. But short term, it was a sell signal. And again, we went sideways, mostly sideways, and we're still a little bit above where we actually closed that day. So it certainly wasn't one of those candles that, where we fell apart. But NVIDIA also is probably, if not the best performing stock over the last year. It's right up there. If we only look at large cap stocks, I can't really think of one right now that's doing better or has done better than NVIDIA over the last year and a half. But there's your bearish engulfing. Look at the volume much heavier, so that it adds to the bearishness in the near term. It just means we got to see this breakout. So I would be right now, I just think NVIDIA is a hold. I don't think it's a buy or a sell. Maybe you could buy on the 20-day, but even that's, I think, a little risky because we do have high closes that are higher versus down PPO that where the highs are lower. So there is a negative divergence here, which means there's a chance, an increased chance that we could go to the 50-day. But I think sometimes I know sometimes these negative divergences simply play out by sideways consolidating. And right now, that's what's happening. NVIDIA really not losing much ground, but the PPO is heading towards zero. But all of this started with that bearish engulfing candle. PDD, this is a black candle. So you got an uptrend, big gap up with earnings, and then we came back down and finished near the low of the day. That black candle on massive volume off of an uptrend usually signals we're going to have some more weakness ahead. And as you can see, we went down. We actually held that prior low. PDD, maybe it's starting to reverse back to the upside. I mean, the earnings numbers were great. I think it's very possible that we see PDD go all the way back up to the top of this candle back near 147. I think a break below 110 would negate all that. But right now, I would be looking for it to go higher. But any kind of a test of 110, and that's the level where you could manage your risk better. But black candle, big volume, gap up, you sell off, but the thing is you still finish above the prior day's close. So you close way below where you opened, but you're still up from the prior day. That's why it's black filled as opposed to red filled. Both filled show closes below the open, but the black filled is telling us that you still finished up from the prior day. All right, just a few more here. Trade desk. Trade desk, big gap up with earnings. That is kind of like a Doji, maybe even like a high wave candle, which I'm not going to get into. That's another candlestick. But in this case, It's got a pretty small body, so it closed, considering how wide the trading range was, I think it's more of a doji because it closed in the middle of the candle, the entire candlestick, very close to the prior open, or very close to that open. So that to me is a doji, but you have a false breakout. You're coming up, you gap up, and then you fail to get that breakout. And I remember writing an article, it might have been the next day here, maybe here, but it was an EB Digest article. And I said, when I see false breakouts like this and no follow through intraday, we actually had a little bit of filled candle, meaning we closed below the open. When I see that, I tend to think that we're going to fill the gap. And the gap was all the way down here around 76. Took about 3 or 4 weeks, but look at where we got to. Probably less than $1 from gap support before we turned back to the upside. So while there's no way of knowing exactly what's going to happen after that candlestick, to me, it was telling me that the odds were greater that we would see weakness down to gap support before we would see a breakout. That's what the odds were telling me. And that would have been correct. And then you get down near gap support. I mean, first of all, Trade Desk had a great earnings report, which is why it gapped up. But the failure to break out tells me we're probably going to consolidate longer, possibly go down to gap support. And so entering the stock closer to gap support makes a whole lot of sense, as opposed to chasing it near key resistance. All right. Next, CSCO. So island reversal. This time, the island reversal is to the upside. So we're looking for uptrends. We're looking for gap ups, leaving one candle alone and then a gap down to basically just leave that candle on an island. And that's what we did back in the middle of June of 2023 on CSCO. Move up about 5 days in a row. We gap up and then we gap down the next day. Now, I don't know what was going on prior, but it looks like we came right up to this high. So that potential reversal was happening right at that resistance. Again, I'd have to go back a little bit further and see if there were other highs, and maybe this one wasn't that important. But if it was, that would be your corroborating evidence to say, hey, there's a good chance this reverses from here. And then from there, what are you looking for? Well, it's uptrending. PPO is positive. I'm probably looking for a 20-day test. So there's your reversal, island reversal. And then here's your 20-day test before we start moving back to the upside. So island reversal at the top, very similar to the one at the bottom. The only difference is this is following an uptrend. The one candle island reversal at the bottom follows a downtrend. Both cases, we're looking to reverse the action, the price action. And then the island cluster at the top. Well, here was one. This is Google. Pulled back. And then we rallied for about 5, 6, 7 days in a row. And then we went sideways. So we have 2 days here. We gapped up, had a nice day. Then we had a down day. And then we gapped down, leaving 2 candles on an island. And then proceeded to go lower, not just the next day, but also over the course of the next couple of weeks. Big breakout on Google today, by the way. So those are the reversing candles that I wanted to talk about. And so the next thing I wanted to do is look at how we scan for possible reversal. So if you go over to Earnings Beats, if you're a member at Earnings Beats, and you go to our home page, which is, let me see if I can find this for you. So if you go back to home, so when you first sign in, you're going to come up to member portal. And then over on the left, there are scanning strategies. So you click on that. There's your scanning strategies. And here's the downtrend reversal. Now you'd have to write a scan that's similar to this, except it's just opposite. I shouldn't say it's similar. It's actually exactly the opposite. But the downtrend reversal scan is what we have in here because we're in a secular bull market. So I'm looking for stocks that are reversing downtrends, not really looking for stocks that are reversing uptrends because I'm not going to short. but you all might want to, and that's fine. If that's part of your trading, that's completely up to you. I just have some strict rules that I follow, and I don't like to short if I believe we're in an uptrend, if I believe we're in a bull market. So I would only be looking at this downtrend reversal. So it's like a pullback scan. And so I clicked on that, and you make sure you're already logged into your stock charts account if you're a stock charts member. And if you do that, after you're logged in, you will see this pop up on your screen. So it literally will go right into the scan engine at stock charts and post everything. You don't have to write anything. You don't have to copy it. All you do is click on the link and it takes you right in. Now, what I like to do is then add some of our research and work, our watch lists, if you will, our chart lists that we have at Earnings Beats. And so I might look at, say, strong earnings. Actually, no, that's the 22nd. That was the earlier one. We had another one since then. So I would look at the strong earnings. Oh, I didn't update it. I didn't update these. Sorry. Haven't updated these since prior week. So well, let's just assume that's the latest. So we'll put in strong earnings, and then we'll put in raised guidance. So these are companies that both beat earnings estimates, look good technically, are liquid, and then also raised guidance. They have to have done all of those things to come up on the scan. They also had to have been showing a downtrend where the intraday high went down at least 5 days in a row. And then today it printed a higher high. So you can't reverse a downtrend until you have a higher high. So this scan, the scan syntax is basically looking for stocks potentially that just reversed. So a hammer isn't necessarily going to produce a higher high, but the day after a hammer would. So it would be confirmation that you just saw the bottom, and then you could look at other corroborating signals. Now, I don't know whether this will, pull up anything or not, but let's just go ahead and run it and see. So I'm going to run the scan, and four stocks came up. That's good. Let's take a look at them. So Applied Materials, been downtrending for more than 5 days. Actually, look at this. Yesterday, it did print a hammer, and it printed it on the 20-day moving average at gap support. And now it's printed a higher high and a higher low. Applied Materials, I mean, you could always put your stop in below, say, today's low, 205.96. Oh, no, yesterday's low. Or that would have been Thursday's low, which was maybe around 203. But if this is a cup and handle back to the 20-day, we should be looking for a target of probably about 215 down to 196, probably up to 234. That's $25 from where we are right now. And I put $5 stop in play. That's 5-to-1 reward to risk ratio. Pretty interesting. So Applied Materials looks pretty good to me as possible. Reversing, I mean, just pulling that up, that scan gives us a possible trade. How about Gap? Yeah, Gap's just kind of going sideways. It looks like a bull flag to me. But I guess today's intraday high went slightly above Thursday's. I'd probably need to see a little more. I'd either want to see more of a pullback or maybe a breakout of this flag pattern. Then you've got LFMD, Life MD, pulling back, printed a higher high, but getting close to that 20-day moving average, which is where I would want to get in. Remember, this stock was over $12 a week and a half ago. Now it's at $10.20. That's $1.80 off the high, which is 15%. And it's getting closer to the 20-day. Closer it gets to the 20-day, the better my reward to risk looks if I'm using the 20-day as my stop. Last one, Microsoft. So Microsoft also reversing off this downtrend off of its 20-day moving average, which if you look back, I mean, during this uptrend, we've had a lot of bounces off that 20-day. And we did just get a breakout after going sideways. Here was a 20-day, almost 20-day test. I think Microsoft's going higher. Again, close below the 20-day. You could use that as a stop. But of these four, I think Applied Materials looks That looks the best to me. And then the last thing I wanted to go over with you today was just a sneak preview of what we're going to talk about next week. Now, this is just, first of all, price support resistance can be defined in a number of different ways. But price support 101. I mean, if you asked me what's your go-to in terms of price support, I will tell you that when a stock breaks out above a prior high, you look for it to come back down and test that high. I could even add another, let me annotate, because I can add one more line to this chart, which will show you almost exactly how this tends to work. So essentially that top, this top, and then this final top right here, all were at roughly 225. Maybe this one was, these might have been 224. I don't know. But we broke out. Look at the volume, big volume, confirming the breakout. And then we came back down, and where did we bottom? 225, the breakout level. That's your initial support. And then you move up, you break out. This is how price support and resistance, I consider it almost like an elevator, in the sense that, let's see, I mean, we could have gone there. We haven't seen a close over that level right there. But here, you break out, you're going from the basement to the first level. Then you come back down, you go up to the ceiling, and you come back down, you test the floor. And now you're going back to the ceiling of the first level, and you break above it. Now you're on level 2. So you go up, you establish the ceiling. You come back down, where do you bottom? On the floor. And you go back up, where do you top? At the ceiling. Waiting for that next breakout in Autodesk to the upside. But this is that stair-stepping pattern that we see a lot when you're looking at price support and price resistance. So just remember, and we'll talk about this again a lot more next Monday, but broken price support becomes price resistance, and broken price resistance, like this, becomes price support on a pullback. So that's what I have for today. John, I don't know if we have questions, but I'll be happy to try to answer them if we do. Or anyone else, maybe Aaron or Tyler. If there are any questions, I've got some time. Or I can just look myself. So hold on a second. Let me see if I can find any. Note you can use green for borders and fill for black candles. I'm used to black and red, but yeah, green's fine. Appreciate the comment. Bar charts also show open, high, low, close. Do you find candlesticks? I can visualize with the filled and the hollow, and that's the part that's missing on a bar chart. It's got the line coming out the left side and the line coming out the right side. Out the left side's the open, out the right side's close. And I can look at a bar chart and kind of get a sense, but filling in that and coloring it just, to me, sets it apart. I just find it to be much, much more visual on candlesticks. Is the candlestick 2 days ago reversing candle? Okay, I don't know which chart you were looking at there. Is there a scan that allows you to capture a hammer the day it is formed? You can actually run hammer scan at stock charts. Look it up in Chart School. And if you have problems finding it, email us at support@earningsbeats.com, and one of us will get back to you. Probably Matt. Matt does a lot of good stuff looking at stock charts and finding answers for you at stock charts. So, but yeah, I mean, it's as simple as like putting it in quotes or something like hammer equals 1 or something with hammer in quotes. I don't remember. You can do it though, and I've done it before. But check out Chart School. What time frame is the best to look at this candlestick pattern? Daily, 4 hours? When I look at candles, my favorite candles are daily because you actually have an open and a close every day. When you're looking at a weekly candle, you're only looking at the open from Monday and the close Friday. You're missing all the other opens and closes during the week. If you're looking at like an hourly chart, you got the open at the beginning of the day and you got the close at the end of the day, but all those candles, every hourly chart is not really an open and a close. So I use them, and I'm always pulling up charts on different time frames, but daily is my favorite. The candlestick on October 27th looks like a hammer. I'm not sure again what chart. I should have said something at the beginning that if you had a question on an individual chart, you provide the ticker symbol or which pattern we were looking at. I guess you said the candlestick also looks like a hammer. So maybe it was the first one that I did. So let me see. That would have been microchip. And you're saying the candlestick on October 27th. Oh, yeah. I mean, I could have used that as a hammer, and we did go up the next day. I might have ended up getting stopped if I'd actually used that one. That one didn't stick out to me because this one was the hollow hammer, which to me is just maybe a little bit more bullish just because you're closing above the open. The first one would have came up a little bit short of the open. It's actually a little bit more like a doji, but I could clearly see why maybe someone would have been a little bit, bullish based off of that candle. I wouldn't have blamed you. So yeah, I didn't even notice that, but good call. I suppose you just do the reversal scan and then see the price movement volume around that. Yes, but you can still see, you can scan for different candlesticks. And in fact, one thing I think you can do is you could go back to the dashboard, and here, if you get down to your scans, yeah, it's there, and hit this more. Now, if you scroll down on your dashboard and you don't see your scans, then the next thing you need to do is go over here to this gearbox and click and make sure that your scans and alerts has a check mark next to it. So if it doesn't, you're going to scroll down and you're going to say, Tom's nuts. I don't see scans anywhere on here. And so then I'm going to go over here and I'm going to click on scans and alerts, save preferences, and then you should find your scans down here. But anyway, click on this more button, and this will give you predefined scans. And if you go down below, you'll see candlestick patterns. And under candlestick patterns, you can look for the single candle pattern, which right here is the hammer. So you got hammer, you got different forms of dojis. I just went over a general doji. I mean, you got dragonfly doji, you got gravestone doji, you got long-legged doji, you got all kinds of different dojis. There's the hammer, 66 of them. But I mean, if you pull them up, a lot of times, the first thing I do is maybe sort it by volume so that you get the higher volume. And then actually look for stocks that maybe EXEL, it's biotech, 2368, 2 million shares. So let's pull this one up real quick and just see what that. I mean, it's a hammer, definitely looks like a hammer, but it's not off of an uptrend or a downtrend. So it's meaningless. So the problem with this scan is it's going to give you everything that looks like a candle, but it's not going to filter out the candles that don't matter. So you're going to have to do that. And then going back here, you can see filled black candles, hollow red candles we talked about. So you got a bunch of those. I mean, you can use this predefined scan as one way. So that's another way to find it rather than actually using the scan engine itself. For a doji, when do you want to buy? Any of these reversing candles, the best time to buy, if it's at a major support level, if I have other reasons to believe that the price is going to go higher, then I normally would want to buy that day if I could right before the close. Because a lot of times you get a reversing candle, next day you get a gap up. Now, the next day when you move higher confirms that the reversing candle worked. But the problem is sometimes you only go up for that one day. So if you wait for that confirmation signal as a short-term trader, sometimes you might be getting in right before it goes back down again. So again, if I'm going to trade these reversing candles, I really want to get as many corroborating indicators to line up bullishly with that reversing candle. It's really important. And when we talk about price volume next week, all of my charts that when I bring them up will be in candlestick form. And so when I start showing you support and resistance, and then all of a sudden you start seeing these candlesticks, it's going to start to click. And nothing in the market's a guarantee. I could have the best setup for you. I could get in, into a pretty large position into a stock that I think has nowhere to go but up based on all these different signals, and the stock could go down the next day. Let's see. Could you look at that bearish engulfing candle on NVIDIA? Does that mean it will head lower from now? No, it does not mean that. But let me pull up the candle and we'll look at it again together here. Again, this is a short-term signal. I mean, the PPO is setting new highs. This is a great uptrend. We're in a secular bull market. NVIDIA is one of the leading stocks. For me, if I was in and I was trading it. Now, if you're holding NVIDIA, that's one thing. But if you're trading it, there haven't been a lot of signals to sell it. That would have been one. And quite honestly, it hasn't broken out, but it really hasn't saved you much either. I mean, here, by the time we hit the 20-day moving average, I don't know that I probably would have waited any longer. I mean, if I got out there, I probably would have gotten in. It wouldn't have saved a whole lot. I mean, maybe $20, but again, this is an $800 stock. So we're talking about what, 2%, 2.5%. Might not be worth getting out of NVIDIA to try to save 2%. But anyway, those are the signals that I look at. This is just a short-term signal. Do engulfing candles always work? Nothing always works. I'll tell you, nothing always works. Anything that I talk about, whether it's price support, whether it's divergences, whether it's the PPO, whether it's candlesticks, everything I talk about is designed to help me manage risk, not to provide a guarantee. So never look at this as a guarantee. Look at this as though, hey, I'm getting a signal that's telling me I probably should sell. And I'm trying to capture my profit, manage risk, and so I sell. Does that mean that it has to go lower and it's not going to go back up? No, it could break out the next day. So none of these signals are signals that always work. And that's, a lot of people that don't believe in technical analysis, that's their argument. They wait until something doesn't work and they'll say, see, technical analysis doesn't work. Well, technical analysis, that's the way it actually works like that. It's not a guarantee. It's not 100%. It's there. The signals are there to help us manage risk. When should run the downtrend reversal scanning? Early morning, midday? I'd run it whenever. I mean, personally, for me, I probably would want to do it later in the afternoon just to give it a chance. I mean, if you do it in the morning, it's got to hit a new high pretty early. And usually mornings are weak. So I think you're probably going to find that it's better to run the scan early afternoon to mid-afternoon. At least give yourself some time if you're going to trade off of it. Give yourself time to look at whatever scan results are produced. Longer term patterns. I'm not sure what that means. Do candles work on the spider? Yeah, they work on anything. They work on, anywhere you have a daily price chart, it's showing you everything that's happening during the day and the open, the close. So yeah, I would use it on just about anything. QQQ, IWM. I think that's just continuation of that question on the spider. Yeah, works on anything. And by the way, I don't know if you saw, but IWM, last week finally took out 208.21. Today's low was below 208.21, but we came back up and we closed at 208.32. So we went down, we held the initial price support on the IWM before we reversed back to the upside. When will the seasonality report come out? It already came out. Unless I forgot to mail it, but it's on the website because I looked at it today. So I'm pretty sure it got mailed out, and it would have been mailed out like Wednesday or maybe Thursday of last week, but it's on the website. So look under seasonality reports. So the candle color will change midday. It can. Yeah. Whether it's filled or whether it's hollow, it can be down in the morning. You have a filled candle, and by the end of the day, It's a hollow candle. I've had members ask me about a chart intraday, maybe even like in the live trading room that we do on Wednesdays, and say, here's a chart, looks like it's a bearish engulfing candle. And my response is, it's nothing yet. I mean, if it's 11 o'clock in the morning, we don't know what that candle is going to look like at 4 p.m. A lot of times in the morning, you get the red filled candle, and by the end of the day, you got a hollow candle and you're getting a reversal. Does it work on all time frames? I think it works on all time frames. I just prefer it on the daily. Because to me, opens and closes, I believe market makers have a huge influence on where we open and close. A lot of manipulation, especially in the morning with the open. And we don't have that kind of manipulation or figuring out exactly where market makers are opening or closing if you look at an hourly chart. Because you're going to have, 6 or 7 candles during the day. The first one and the last one reflect a true open and a true close, respectively. But the 5 in the middle, it's intraday trading. There's no real open and close. The open at 10 o'clock is basically the same as the close at 9:59:59. So you're not really getting opens and closes. What did the black candle on Google 2 weeks ago tell you? Let's take a look at that. Here, I would have looked at that. Actually, I wrote about that. I think I did an EB digest. And I would have expected at least a movement to the downside. And in this case, we went down one day and then reversed back to the upside. But that is a shooting star off of an uptrend. So I would treat that. I mean, it is technically a black candle as well, but it's not really filled much. This is more like a, upside down hammer. And the reason that I thought that we probably would see more selling afterwards than we actually did is because I was looking at this as a neckline. So we had an uptrend, left shoulder, left side of the neckline, head, right side of the neckline. And I thought we might pull back to these moving averages, put in a right shoulder. I think I was talking about maybe getting back down to 140 or low 140s and then break out. We didn't really do that. We went down only for one day, and then we made the breakout to the upside. This is a really big breakout that we saw today with volume increasing. I like Google. I've been kind of shying away from it for a while because it didn't perform very well on a relative basis, but it's starting to show much better strength. So while this one was struggling, while some others like NVDA kept going up, we might see some others like NVIDIA going sideways for a period of time, while others like Google start to lead again. But I really like that breakout. All right. I'm just going to take a couple more because it's getting late. I'm getting a little tired. Is this recorded? Yes. We record all of our sessions. So this will be recorded. It'll be sent out later tonight or tomorrow to everyone. We have to do a little editing probably, and whatever the rest of the awesome EB crew has to do, they'll do, and then we'll get it sent out. Longer term, use weekly charts. Yep, talked about that one earlier. Do you like to see high or low volume when testing support? Well, I love to see a false breakdown on heavy volume, because to me that suggests that we had a big breakdown on heavy volume. And if traders see that, they'll short, or if they're long that stock, they'll get out. And so they'll add to the selling. So when you get heavy volume intraday breakdown, and then you get a reversal and it's all on big volume, it tells me market makers are putting their capital to use. Because I don't know about you or any of you all, but I'm not buying a breakdown intraday that's showing heavy volume. It's the last thing I would be doing. So that is a pretty good sign that you're getting some market maker action when you get a false breakdown and a reversal. And the fact that we saw a couple of those back to back on that one chart someone asked me about earlier, I mean, that tells me they maybe had 2 days where they were doing some serious accumulation. So, yeah, I mean, I think anytime you see the big volume with those reversing candles, then you need to be aware of the possible market maker activity that's taking place with that. Mention that this analysis work in index ETFs. I mean, index ETFs are maybe a little less volatile. And I don't know, I'd have to go back and look at individual index ETFs to see which ones open literally at the open. Because if you look at the candle of the SPY versus the $ SPX, the SPY right at 930 will give you a really good indication of where the spider is, where the S&P is opening. But sometimes the S&P 500, it's a delay. And so the candles on those two charts, even though they're basically the same, sometimes look a little bit different. So I would use the ETF that tracks the index when you have one. Can I explain highest jig? I don't know what that means. What about a bearish harami? I mean, I don't get into it because it's not one. I mean, the candlesticks that I personally used here are ones that I've used, that I've traded with over time. So it's not that I don't follow harami or I don't wouldn't suggest it. I mean, if you find that it works for you, I would go ahead and maybe use it. I always go back to whatever works. So if you get a harami, I mean, it is considered a trend reversal pattern. And it can be either bullish or bearish, just like, the island reversal. It can be bullish or bearish, just depends on where it shows up on the chart. A harami is basically the same thing. And for those of you who maybe aren't familiar with harami, it's where you get a candlestick where you're going up the first day, and then you have an inside day the next day where you gap down and you trade in the middle of that prior bullish candle. And if that occurs at the top, or it occurs maybe near a price resistance level, then, like all these other candles, that would be one that, you might use. Just like when I talk about technical indicators, I don't go through all stock charts technical indicators. I go through the ones I like to use, and similar with candlesticks. So there are going to be other patterns out there that other traders use. I mean, trying to think what that book is that I use, or that I first read. Hold on one second. Give me about 3 seconds. I'm going to grab this book. Hold on. Okay, so the first candlestick book that I followed, and I learned a ton from it, was the Candlestick Course by Steve Nisson, or Nisson, Nison. And that's, I mean, I went through that cover to cover, and I started looking at the patterns, and I started reviewing, researching and looking back years to try to just gain a better visualization of what these candlesticks look like, so that when they formed in real time, it would make me feel more confident about my trading. And so I would highly recommend that book. There are other candlestick books, and I'm sure they're all pretty good as well. But Steve Nisson, Nison, published the Candlestick Course. And this was a long time ago. I don't remember when I got this chart, but it was many, many years ago. So probably was published back in the 1990s, I'm guessing. I don't know if it shows on here. Yeah, I'm not seeing. Oh, the copyright is 2003. So anyway, you can check that out. Again, maybe 2 more questions. I want to get out by 6. How often are you using the predefined scans from stock charts, or are you using your own scans? I use that downtrend reversal scan. I just figure, regardless of what candle is printing, if I've got a stock that's going down 5 days in a row, and remember, these are stocks coming from our stock charts, or our chart lists. So these are already stocks that we've vetted, whether they're strong earnings, whether it's raised guidance, whether it's the strong future earnings, whether it's our bullish trifecta chart list. I mean, these are stocks that generally we already like for the most part. And if you're telling me that I can go through all of these chart lists and quickly find any stocks on these chart lists that have gone down 5 days in a row, that's going to be like gold to me as a trader, knowing that, hey, I don't have to go through and look at every chart on every chart list. I can run this scan and it'll give me a really good idea of some of the stocks that have been struggling recently. I don't have to buy them, but it just gives me a quick filter to find some that I can take a look at and see if it meets my criteria and if it looks like a solid reward to risk investment. Last question is, how did you get the $30? Oh, and the other question was, can you explain higher high? I'll do these two and then wrap up. So a higher high is simply, if you're looking at a daily chart, one day's high being higher than the previous day's high. So for instance, I mean, if I'm looking here on Google, I mean, I can see several days. See if we zero in here. But I mean, you see these two candles right here. This is the intraday high. The prior day, this was the intraday high. That is a higher high. Then if you come down, you start to see one lower high, two lower highs, but then here's a higher high. So it's not going to meet that 5-day filter of going down 5 consecutive days. So you've got to have some pretty serious weakness to have 5 consecutive candles where the highs are lower than the prior day, 5 days in a row. So anyway, I think that that's a good place to start. Last thing, how did I get the 30-day extension on Applied Materials? Well, let me just pull up the chart. And I will look at just the last 3 months. And I'll annotate this for you. So what I'm looking at, and I didn't talk about it because it really wasn't the topic for tonight, but basically with Applied Materials, I'm looking at a stock that's going up. And anytime you got a stock that's going up and it puts in a cup, which would be from this high down maybe to this low, and then over here to this high, that's a pretty nice cup right there. And so you get this uptrend followed by a cup handle down to the 20-day moving average, and also hits gap support right here. So uptrend, cup, handle, down to the nice little hammer right there with a red filled candle, but still a hammer, as it tests the 20-day moving average and as it tests gap support. It's a great entry point into Applied Materials. Now the measurement comes from top of the cup to the bottom of the cup. So I'm going to say from, let's see if I can find you can do this based on dollars, or you can also do it based on percentage. But basically it's from right about there up to maybe about there, which is 9%, 9.3%. And I can't, I could, normally I can grab this thing. I could grab it. And whoops, I didn't mean to grab it and take it away. I meant to grab it. And there. So I could, but stock charts doesn't give you the ability to have more bars or more rows to the upside. You can add bars to the right side and make more room, but you can't do it to the upside, which I've asked them a couple of times before, and they've said that they are going to do it at some point. I just don't know where it is on their priorities. But anyhow, if you just take, I don't know why that thing's saying 234% now, but basically if I went up 9.3% from 215, you could do the math, but it's probably somewhere around 234, 235, which would be roughly $20. And from 215 down to 197, that's $18. So maybe it's 233. But anyway, right in that ballpark is what we'd be looking at. So that's how the measurement was determined. But it doesn't confirm until you get the breakout above 215. So that's what we're waiting on Applied Materials. But I personally think it's happening. All right, that is it. I want to thank everybody. I mean, I know there's still a lot of other questions. If there's something that I didn't get to that you really, really need to try and figure out, send in an email to support@earningsbeats.com. My problem is that we have a lot of members and we get a lot of questions. And I may start trying to answer some of these. I've said this before, by the way. Haven't done it yet, but the intention is there. I may start doing some sort of a question and answer segment on one of my shows. Maybe it's my Tuesday morning show on Trading Places Live. And so I may try to answer some of the questions there. And then we can reach out and let members know that, hey, every Tuesday, go back and look at the video. If you can't see this live show, go back and look at the video. And let's say at the 20-minute mark, I'll do questions for 5 or 10 minutes or something like that. That's the hope. But anyway, write in if you have a question that's really important or significant. We'll definitely try to either get it on a show or I'll try to respond. But honestly, if I responded to all the questions that came into Earnings Beats, I wouldn't have time to do anything else. I get a lot of questions and unfortunately just can't keep up with them. And responding back to everybody one at a time, getting members that, might be asking similar questions. It would be easier if I group them and respond on a show rather than trying to get back in touch with every individual person. So hopefully you can appreciate that. But that's it for me today. We're going to do another one of these episodes next Monday. It's going to be price, support, resistance, or that combination of price and volume. I think the combination of candlesticks and price volume, these are two of the most important and most basic parts of trading. And so these are the two I really want you to be aware of. If you are on our EB Digest currently and you're getting this for free, the last two that we do will be available, but only to members. But you can be 30-day trial member. Many of you already are. And if you're a 30-day trial member, you're going to cover all these sessions and you don't pay until the end of 30 days. So you're getting them essentially for free either way. But I just want to let you know that the last two, you'll need to be a 30-day free trial member. The first two open to everyone, including EB Digest subscribers, but the last two you'll need to be members. And that's, gets a little closer to the heart with specific trades and some of my own personal trading strategies. I think at a minimum, trying our service, I don't think that's asking for a whole lot in return. Anyway, everybody have a great rest of your evening. I'll be back next Monday for the next event in this educational series. Have a great evening, everybody. Happy trading.